looking forward to this conversation where we talk through Bitcoin valuation, and I think even more broadly than that, your thought process about technology, about markets, and about the way that valuation gets done in general.
Yeah, no, it's been a very interesting space to be in over the last 7 years, and it's fun to see all the traditional asset managers finally starting to pay attention to what's going on. So it's starting to get really exciting.
For a little bit of context, let's talk a little bit about your background and how you got invested and interested in Bitcoin.
Mm-hmm. So I started off in traditional finance when I was 22 years old. Started with a company called A.G. Edwards & Sons in St. Louis as a stockbroker. I was doing the retail stuff for a couple of years, and then I picked up a few institutional clients, and I started focusing all my efforts on being an institutional equity broker. So I was there for 14 years. I left in 2004. I was a senior vice president when I left, and started my own registered investment advisory firm in 2004. And basically, I just cherry-picked my top clients and was managing money for them for about 10 years as an RIA. And basically, they were endowments and foundations in the St. Louis area. So I was their outsourced CIO for 7 endowments and foundations, managing about $350 million for them. And then in 2014, I learned about Bitcoin. I saw Cameron and Tyler Winklevoss on CNBC being interviewed by Andrew Ross Sorkin when Bitcoin was around $100. And coming from the traditional finance world, I just thought it was a total scam. I didn't understand what Bitcoin was. I just thought it was this internet funny money. I just didn't comprehend what it was. And it took me a good 6 months to figure it out. And after I figured out what Bitcoin was, which is basically just open source internet protocol software that allows us to transfer value peer-to-peer through the internet without having a third party clear that transaction. It just, like a light bulb clicked on, and it's like, I just understood how we're going to rebuild our entire financial system on blockchain technology. And so I convinced my wife into allowing me to sell my practice. And I sold my RIA and became a venture capitalist in the blockchain space. And, I had no idea what, a venture capitalist does, but, that's, kind of, how I got started back in 2014. And then just, got involved and, helped start building and financing and mentoring blockchain companies. And that's what I've done for the last 7 years.
Yeah, it's so interesting to me because you mentioned getting started in Bitcoin in 2014. But as you mentioned earlier, the journey begins 30 years ago in terms of how you think about markets, how you think about technology, and how you think about valuation. Walk us through that.
Yeah, I've always had a value tent, being, professional portfolio manager, looking at undervalued assets, in traditional asset, minds, that's called Benjamin Graham or Graham Dodd investing, kind of like what Warren Buffett does. Basically, we're trying to find, a dollar's worth of assets for 50 cents. And so when I first started my career, basically we're trying to find, a dollar's worth of assets for 50 cents. And so when I first started my career, I read, all sorts of books from Peter Lynch and, Benjamin Graham and how to be a great investor. And, but when I first got started when I was 22, I really didn't know what I was doing. Fresh out of college from University of Illinois. And, I thought being a stockbroker was a financial management or analyst type job. But after I actually started doing it, I realized it was a sales job. And so I went to one of the most experienced people in our office at the time. We had about 105 brokers in our office. And Leo Samet, he was around 80 years old, and he had started with A.G. Edwards 60 years prior. And, he was very successful. So I went into his office and I was like, hey, Leo, I'm new. You're successful. Can you share a few tips with me on how to have a long career in this industry and be successful like you are. And Leo is kind of funny. I remember this like it was yesterday. He and this was, I guess 30 years ago. Yeah, 30 years ago this happened. But it's still so fresh in my mind. He looked at me. I mean, it was probably just for like maybe 10 seconds, but it seemed like it was like for at least a minute, like just kind of sizing me up. And I guess in his mind, he was thinking, should I really share the secret of success with this kid? And so he didn't say a word. All he did was he put his hand on a piece of paper and he slid it over to me across his desk. And he goes, just put all your clients in this. And what he slid me was a value line report on a company called Berkshire Hathaway. And so this is back in like 1991. Berkshire Hathaway was, it was less than $10,000 a share. I think it was 8,000 or something like that. And he goes, just put all your clients in this. And I looked at him and I was like, my clients aren't going to buy an $8,000 per share stock. Don't you have anything that's like $10 or $1, like a penny stock? And, that's what I was thinking in my head, because I didn't know how to value a company. I didn't know the value of, Warren Buffett, who ran the company. I didn't know how to value the free cash flow being generated by the company. I didn't know how to predict that interest rates were going to drop from 10% basically down to zero over the next 30 years, which would increase the value of the company. And so I was just unaware. And so I never bought the stock. And, over the next 30 years, Berkshire Hathaway went from, like I said, around $8,000 up to, over, I think today it's like 410,000 or so. And they've never had a stock split. And so, that's where I learned that, you don't pay attention to the price. The price isn't what matters. It's the value that matters. And I equate that to Bitcoin today because a lot of people are looking at Bitcoin at $61,000 a coin. And they're like, oh, I don't want to buy it. It's too high. I can't buy a whole Bitcoin. I rather buy like Dogecoin at, 23 cents. And that just doesn't make sense to me because, there's value to Bitcoin. There's really no value to Dogecoin. And so, I think what's going to happen is over the long run that people that invest in Doge are going to be hurt, and people that, understand how to value Bitcoin will, be much better off.
One of the other things that I enjoy about your analysis, about the way you think this through, is your analysis of S-curves. Give us a sense about how you came across S-curves and why they're so important in the way that you form the thesis around technology.
Mm-hmm. Yeah, back in 1988, I had the opportunity to go to Cambridge University and the London School of Economics to do my study abroad my junior year. And when I was at Cambridge, one of the classes I took was about macroeconomics. We were actually in Sir Isaac Newton's classroom. He used to be a professor at Cambridge. And so we learned about S-curves. They're in bubbles, the history of stock market bubbles. And so it's always been important to me to use this information. And I based my entire career on, being able to foresee the next S-curves. So back in the early 1990s, so I graduated college in 1990. When I graduated, only 10% of U.S. households owned a personal computer back then. And by year 2000, it was 90% of households owned a personal computer. But when the personal computer revolution started, it started in the very late 70s, early 80s. And so, in 1980, about 0.1% of households had a personal computer. And so that's what S-curve is. It's the amount of time it takes for a new technology to go from 0% adoption to 10% adoption is the same amount of time it takes it to go from 10% to 90%. So you can go back and look at, shipping companies in the 1400s, railroads in the 1800s, automobile companies in the 1940s and 50s. I mentioned computers in the 80s and 90s. And then, I use this for, the computer S-curve, the internet S curve, the mobile internet S curve, which is basically Apple, and then now blockchain S curves. So Bitcoin was invented in 2009. By 2019, 10% of US households own Bitcoin. And then last year, Brian Brooks, the comptroller of the US currency, mentioned that 15% of US households own Bitcoin. There was a survey that came out earlier this year of 30,000 people that showed 25% of US households own Bitcoin. So we're on this mass adoption, this mega trend of mass adoption of Bitcoin in the United States. And what this tells us, if it took 10 years to go from 0 to 10, then it's going to take 10 more years to go from 10 to 90. So from 2019 to 2029, in 2029, we should hit about 90% adoption of Bitcoin or digital wallets or some sort of crypto assets in our portfolios. And so this megatrend is in place and it's completely unstoppable. And you either get on board or you get run over the next 8 years. And for people that spend the time to learn what Bitcoin is, I think it would be a great benefit to them just to take 20 to 40 hours and devote to this to understand what this is, so that you could participate in this new megatrend.
Yeah, I've always found this chart and this analysis to be fascinating. It reminds me of the joke about Hemingway talking about how you go bankrupt gradually, then suddenly. The idea is that there's this extraordinarily long period of time where a technology kind of kicks around without gaining traction. Early adopters talk about it. People who are in the space talk about it. And it seems like nothing happens. And then suddenly, all at once, it seems like it just goes parabolic. It's everywhere. Everyone's talking about it. And the adoption rate goes, as you say, from 10% to 90%.
Mm-hmm. Yeah, another analogy is that new technologies are worthless until they're priceless. And they just flip that fast. The internet was worthless. And then all of a sudden it was priceless. We can't live without it. It's going to be the same thing with Bitcoin and blockchain. 10 years ago it was worthless, and it's becoming priceless.
Yeah, it's also interesting because it seems to involve network effects. The value of having the first fax machine is, as you say, worthless because no one else has one. You can't communicate with it. There's nothing that you can do. You can extend that metaphor to the internet. You could talk about it in the context of blockchain in terms of value. If people don't have a way of receiving that value, then it doesn't really have any ability to sort of transmit value. So it's this fascinating idea. I'm curious in terms of where we are right now. When you look at these curves, you've got a couple of marks on this chart plotted. The first is this is where Bitcoin is right now. It looks like around the 25% mark. And then you have the shakeout phase that comes, it looks like around 40 or 50%. Tell us a little bit about what that means and how you interpret it.
Yeah, so when a new technology starts to be adopted, when between 40 to 60% of the market participants are using that new technology, you get the shakeout phase. And the shakeout phase is when the unproductive, useless, or the ones that provide no utility, just evaporate and they just go away. So let's look at computer companies back in the 1980s and 90s. So in the early, mid 80s, you had hundreds of computer companies. You had Commodore, like the Commodore 64, and you had Acer. You had Sinclair, which was my first computer back in 1982. And then you had, Gateway 2000 and Dell, Compaq, IBM, and you had, like I said, hundreds of computer makers. Well, the ones with the good business models survived. It's like Dell had a direct-to-consumer business model. That was an innovative model. So they survived and they flourished. But a company like Commodore or Atari or Sinclair, their business models weren't very good, so they disappeared during the shakeout phase. So, and that's why that will happen with blockchain technology. There's over 7,000 cryptocurrencies or tokens that are trading today. 99% of them, or I would say, are basically useless and provide no utility. And when we hit that shakeout phase, probably in the next year to 3 years, it's somewhere when we hit that 40 to 60%, those are going to disappear. And the ones that do provide utility and value, like Bitcoin and a handful of other ones, they'll survive. But in my opinion, I think almost all of the tokens that we see today will vanish over the next 3 years, and we'll be left with a handful of those going forward.
Yeah. Talking more about valuation, let's take a look at the historical Bitcoin trend growth chart, because this is also, I think, a very powerful visual. So it's important to note that when we look here at the y-axis, it's semi-log y. This is a logarithmic scale, and that's why you see the price growing linearly on this chart. It's actually growing exponentially. It's just a logarithmic axis. Talk a little bit about the significance of this chart and what it means.
Yeah, so we use 4 models to help us value Bitcoin, and this one's our most simplistic one. Like you mentioned, we just take the 12-year price history of Bitcoin, we plot it out on a logarithmic scale, and we run a regression line through the center of that. And so this basically just tells us, is Bitcoin overvalued or undervalued versus the trend. But what's kind of interesting is that this model is 90% correlated to the historical price of Bitcoin. So it's a pretty good model to use. And so the model basically says that Bitcoin's fairly valued today, and that it should be worth near 80,000 by the end of the year, and 150 or so next year. And in a few years, it's saying that Bitcoin should be worth about $500,000 per Bitcoin. And so, but the price could be 2 standard deviations above the model, or 2 standard deviations below that trend line. So it's not really a way to predict if Bitcoin is going to go up from 100,000 to 500,000 in the short term. It's really if you're entering Bitcoin, are you paying a fair price, or is it undervalued or slightly overvalued? And like I said, today it's fairly priced at right around 61,000.
We talked a little bit about this before informally, what the value of the network is, or network value. Let's take it a little bit more formally and walk us through this chart, looking at Metcalfe's law and Bitcoin.
Mm-hmm. Yeah, so Metcalfe's law is a way to value the way to value a network. And so networks are like eBay that matches up buyers and sellers, or Uber that matches up drivers and riders, or like Facebook that matches up friends. And so, we could use Metcalfe's law to value Bitcoin too. And so the model that we use, this model was invented by Tom Lee at Fundstrat probably about 4 years ago. And so what we do is we square the number of users on the Bitcoin network, and we multiply that times the transactional value of dollars basically going through that network. And when we do that, it comes up with a model, and we compare that to the actual price. And between 2014 and December of 2017, the model and the price were very highly correlated, like 94%. And you can see that with the lines being close together. But what happened in December of 17 was the government basically allowed people to short Bitcoin through the futures market. And so the model and the price started to diverge. And then the U.S. government went on a massive misinformation campaign around Bitcoin. Every time I saw a government official talking about it, they were saying it's used for nefarious activities, it's used for criminals, regular folks shouldn't touch it, and it was just they were pushing people to, they know they can't stop people from buying Bitcoin, but what they could do is convince them that you really don't want to be involved with it. And so, this made the model value and the price deviate. And so you can see where the 2 lines separated, and that created a lot of value in Bitcoin. That was a good time to be an accumulator. Because if you believe the model is right, then, and the price is well below that, then you should be buying. And so now the model and the price have come back together, because we have actually seen the shorts closing out. So they're having to buy back their Bitcoin that they were short. And we've seen, the U.S. government not be so negative towards it. We have senators today, Senator Lummis and Senator Rand Paul, speaking positively about Bitcoin. There's a blockchain caucus in Congress that's actively promoting, blockchain initiatives and, support of this industry, in Congress. And we've seen miners move from China to the U.S. To get better treatment. So, the U.S. is becoming, more favorable towards blockchain technology and Bitcoin, and this model versus the price show that.
Yeah, and we should add that the shorts got their faces ripped off as Bitcoin moved from about 1,000 to 60,000, 60x. Not a place you want to be short, not a place you especially want to be leveraged short. And for people who were there at the time, this is the period we call crypto winter after the ICO bubble collapsed. It really is a fascinating model because it really talks about the one way of thinking about what potential intrinsic value is, something that we touched on before, but this shows kind of a mathematical model for how you correlate the use in terms of the number of wallet addresses and the volume of transactions to the price.
Mm-hmm. Yeah, this is one of my favorite models. Yeah, I'm glad Tom Lee came up with it.
So let's keep moving as we walk through this valuation model, or this sort of different slices, different views of the valuation model. You also look at stock to flow ratios.
Mm-hmm. Yeah, so there's two stock to flow ratios that we look at. One is using dollars, and the other one's using gold as the monetary unit. So the one using dollars, and if you're not familiar with stock to flow, you just Google Plan B or 100 trillion USD, and you'll come up with Plan B's website. And you can read through his methodology on how to, the stock to flow model is built. But this model is 95% correlated to the historical price of Bitcoin. So this one's very accurate too.
So we're looking first here at the dollar denominated stock to flow model. And again, semi-log Y, logarithmic scale on the Y-axis.
Mm-hmm. Yeah, so on the stock to flow model with Plan B, basically stock to flow models are used to value commodities like gold, diamonds, silver, platinum, palladium. And so if you throw Bitcoin into this valuation method, basically what it shows is that gold is the scarcest asset on earth today. It has a stock to flow ratio of 60 to 1. So the stock is the amount of gold that's ever been mined, that's above ground, that's being stored. And the flow is the amount of new gold that gets mined every year. So it's a 60 to 1 ratio. Bitcoin's stock to flow ratio is 45 to 1. And so gold is scarcer than Bitcoin because it's 60 to 1 divided by is more scarce than 45 to 1. But after the next halving, Bitcoin halving in 2024, Bitcoin's stock to flow ratio goes to 90 to 1. And so Bitcoin becomes the scarcest asset on earth in 2024. And so if you look at the total value of gold today, it's worth about 10 trillion. And the total value of Bitcoin is a little bit more than 1 trillion. And if you think about it, if Bitcoin becomes the scarcest asset on earth in 2024, it should be worth more than gold. So to me, that means that Bitcoin should be worth more than $10 trillion in 2024. And that's what this model shows. It just shows it in like a graphical format with dollars. So what this shows is that at the end of this year, Bitcoin should be worth about $100,000. At the end of 2025, it should be worth about $1 million. And the end of 2029 shows that one Bitcoin should be worth about $10 million. And this model is 95% correlated to the historical price of Bitcoin over the past 12 years. So it's very accurate and it's working as clockwork.
Let's talk a little bit about the distinction between price and value as you construe those two terms.
We talked about like Berkshire Hathaway, and at 8,300, it was, to me, it was overpriced back then 30 years ago. And a lot of people are thinking that Bitcoin is overpriced today because it's $61,000. But if the value of Bitcoin is going to be $10 million in 2029 and in 8 years, Bitcoin is really one of the most undervalued assets in the world. And that's the way I look at it. I don't really look at the price of Bitcoin. I look at what the value is. And, I believe that this model is true. I believe that, one Bitcoin is going to be worth $10 million in 8 years. And, if you're paying less than $10 million a Bitcoin, you're getting a good value. And if you're paying $60,000 a Bitcoin, you're getting a great value. So, one of my goals is to accumulate as much Bitcoin as I can.
Yeah, this is such an important point, I think, foundationally to set up for people who are relatively new to the finance space. And this is the idea of unit price versus market cap or total network value. The market cap is equal to the price times the number of units outstanding. Multiply those two together and you get the total market cap. This is a fascinating point because of something that we're seeing right here, right now in 2021, which is sometimes called unit price bias or nominal price illusion. The idea that people are, for example, crowding into Shiba Inu because it has 4 leading zeros and the price, it's some minuscule fraction of a cent, 10 to the minus 4 or whatever it is. And people think, wow, that must be very cheap. It must be a good value. People are plowing money into that without any real use case that anyone can see, describe, or understand. You have Bitcoin trading over 60,000 as we have this conversation today. People look at it and say, well, that's very expensive. Give us a little bit of a sense about how you talk to that when people ask you those questions.
Yeah, so you make a great point. So, you're paying like 0.00007 for that, and but it's, the price is cheap, but you're paying a cheap price for something that's worthless. So I rather pay $61,000 for something that's has an infinite value to it. And so it's I've seen this like throughout my career. I don't know, it's been 30 years and I can't believe investors still do this. But and it was a mistake I made 30 years ago too. Like I didn't understand the difference between price and value. The price is irrelevant. You have to understand what the value of it is. And even if you're paying a penny for something that's worthless, you're still overpaying for it. And so I just think that investors aren't going to get hurt with these meme coins, meme dog coins, and it's going to hurt the entire industry when that happens. But we're a free country and people are free to make mistakes. So it's investor education that's going to happen, I think, over the next couple of years as these meme coins kind of fade away.
Yeah. The other interesting thing about this is sort of in the digital asset space, you have the ability to slice digital assets into smaller and smaller component parts. With Bitcoin, for example, Satoshis are 1/100 millionth of a coin. So the idea is I've had people who I think are pretty sophisticated in the financial space ask me recently within the last year, do I have to buy a full Bitcoin or can I buy a fraction of a Bitcoin? So understanding how assets in the digital world work, how they're divisible, very different than when you had to buy, there was no Robinhood in 1991, I can assure you. And when you wanted to buy a single share of Berkshire Hathaway, you had to actually pony up over $8,000 to do it. So it's kind of a different world we're living in today, where this idea of unit price bias seems even kind of more absurd, I guess.
No, you're 100% right. It's just, so there has been a push recently. I think Michael Saylor's been pushing this over the past month to stop pricing Bitcoin in terms of Bitcoin, but price Bitcoin in terms of Satoshis, like you mentioned. And then, I think that, is under consideration with some of the exchanges that are out there. But, we haven't seen anything yet. But, I don't know how I feel about that. It kind of feeds into the fact that I'd rather have 100 million Satoshis rather than one Bitcoin. That's equivalent to saying I'd rather have 100 pennies versus a silver dollar, right, or a paper dollar. So, or rather have 10 dimes instead of a dollar. So it's just it's all the same value. It's just how do you want to count it, basically?